If you look at the last 6 major oil events going back to 1973, if you had bought within the crisis itself, you would have made money.
Well, we got a new host. Brilliant.
That is... Cheerio, Richard. The oil price they mark up 4%, 5%. Equity markets down 0.75%. Everybody spends the whole weekend going, oh my God, here we go again. It's exactly the same thing. We open on Monday morning, everything rallies. So the real question for us as a group is, should we be adding risk?
For me, the dilemma is, do you put some more money in the US just for sort of short term, or do you go and buy the things that are being hit the hardest? For choice, I'd probably buy America.
God, that's a surprise.
That wasn't 50-50.
All right, 70-30. Okay, you got me.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. To episode 37 of The Art of Investing, brought to you by IG, the global investment platform. Joining me, as always, in the red corner, we have Chris CJ Fellingham.
Oh, hi, Rich.
And my equity expert, Mark Spice Holden.
Thank you, mate.
Also joining us today, we have a very special guest. It is Roger Lee, Head of Equity Strategy at Cavendish. Now, Roger is the ideal guest for the scenario that is going on in the world at the moment, because he is the expert at bringing together geopolitics and macro and putting that together with the relationship with asset prices. So very good to have you here, Roger.
Thank you. Very generous
introduction. Welcome, Roger.
So I think we'll go straight to the Spice Market update today, because I know that CJ wants to ask me how many winners I had at Cheltenham. So, Mark.
And the answer was?
The answer was none in 2 days. But I'll tell you what, I did have one big win. And that was, as you know, I left here, scurried up to get the train at Paddington. Managed to get to Cheltenham around 2 p.m. So, of course, that's after the first couple of races have already gone. Put my bag into left luggage, and there was an Irish family just in front of me, and I let them go before me. And we had a little chat, and I said, that you off already, is it? He said, aye, sure, we're off. And I said, I don't suppose you're done with your badges for the day, because I hadn't got a ticket yet. I was going to have to go and buy a ticket from a ticket town. And they said, oh, sure, yeah, here you go. Let me get my father's one. And she got her father's one. Pins an owner's and trainer's badge on me for the first race. And then a wristband that got me into any place I wanted in Cheltenham.
Fantastic.
So the rest of that day was the best day I've had at Cheltenham.
So what you're saying is you went there, you had your good gift of the gab to get in there without paying for anything, did a lot of research and had no winners.
And then lost it all in gambling. Yeah.
Well done, mate.
So on to the Spice Market update.
There we go. Anyway, this week, we've had Trump getting his begging bowl out, but let's talk about stuff that's going on outside the Middle East first. It's been another interesting week in the background. Quite a sort of contrast, really. You can see what's going on in Europe. So last week, Rich pointed out that On the Beach, which many of you will see advertised on the telly if you want to go on holiday, had a profit warning. Yesterday, Delta Airlines had a profit warning on the upside, saying that they're starting to see a big pickup in revenues in the US, even though they've had to absorb an extra $400 million bill from the higher oil price. And the shares are up 5%. So they're guiding people upwards, and they're seeing a big pickup in what you call the premium traffic. So where CJ gets on a plane, he turns left to first class, the rest of us turn right down to capital class, but they're seeing the premium go up. So CJ is obviously spending a bit more time out there. Also, it's sort of a bit of a guide to what's going on in the US economy. New home sales came out today, and they were a bit stronger than expected. Again, this is also pointing to the benefits of the one big beautiful bill beginning to gather a bit of pace and them basically ignoring what's going on in the Middle East. Other company news, Meta, who obviously own Facebook, there's a story coming out of Reuters saying that they're looking to cut 20% of their jobs, which is pretty punchy, really. And I think there's a very subtle difference, because Google, Alphabet, as it's also known, yesterday basically said that they were starting to impose spending caps on some of their more blue sky research projects in AI. So I think you've seen some of these big companies, as we know, splurging the cash, going for capex like mad back up until sort of in the second half of last year. And now they're reining back and looking for cuts.
Mm.
Now, Meta is saying that potentially this is because some of the productivity gains from some of the AI they've put into their business is starting to pay benefits. So we'll see. But that's not official yet. That's something that Reuters ran with. And we'll see that. The other big news, the world's biggest company, NVIDIA, as you know, have a big conference that started yesterday and runs until Thursday this week. And basically, they were saying that they're expecting now to generate $1 trillion of revenue by the end of 2027 in that year. And that's up from about $500 billion, 500 billion, that they guided to sort of in the second half of last year. So the AI spend is still coming through thick and fast. But like I say, just to the edge, signs that maybe looking at cost cutting as well.
I mean, I wasn't watching it, but NVIDIA comes out with this, which is presumably good news.
Yeah.
What's the stock price done on the back of this?
I mean, it went up at 2 or 3% from where it was trading just before it. And like I say, I think Jensen Huang, who basically is the CEO, is going to speak another couple of times before the sort of conference is over. But that was the main sort of speech, and it was obviously pretty positive.
And it's kept the 2%, 3%. It hasn't.
Yeah, I haven't looked at it.
I don't know. Rich, you look at it.
It was up to he came out with the 1 trillion number. It spiked up 4.5 and then dropped back to up 1.8. So it's that sort of, the market just is not buying into any of this AI bull story anymore. Same with Oracle. Oracle traded up to 168, right back down to 155. So AI is not where the money's going.
And this is really important actually for the S&P as we get on to talk about the S&P. I mean, there's one of the stats I quite like about AI is that 70% of the S&P's performance since November 2023 has basically been correlated to or identified as related to AI. So the amount of expectation that's in all of the S&P really is phenomenal. And the second stat that I quite like is that 50% of the S&P is now in the top 10 stocks, plus the two Anthropic and Tesla, SpaceX.
Has that ever happened before, Roger?
Never.
But it's a bit like the FTSE. The FTSE's top 10 stocks are about 50%.
One always has to be slightly careful when you start throwing stones at the S&P because of the concentration risk, because the other concentration risk stat that I think you're referring to, Mark, is that 30% of last year's performance of the FTSE came from two stocks, HSBC and AstraZeneca. So, yeah, we're careful when we talk too much about concentration risk. It's fine when we're talking about the US. Obviously, we ignore it when we're talking about the UK.
Absolutely. Here.
This week, normally we would be reporting on a Thursday. We're recording this on a Tuesday afternoon. But this week's a really busy week for central banks, which we touched on it last week. Overnight, we've seen the Royal Bank of Australia basically put through their second interest rate rise in 2 months. So they're sort of trying to fight off a little bit of a spike up in inflation they're seeing there.
They're going the wrong way, aren't they?
And was it discounted some weeks ago they were going to be raising rates, or is this a new rise, which might be linked a bit to this situation with the oil price moving up and stuff like that? Or was this all that was discounted anyway?
No, I think when they put the rate rise through a couple of months ago, they were saying, well, now we'll wait and see for a bit. But because the oil price has gone up, I think they specifically mentioned the fact that the oil price had gone up, which is one of the reasons they wanted to put through this extra quarter point rise, which, the market wasn't expecting, but was very quickly discounted. I mean, we've got the Bank of England on Thursday this week, probably when this podcast comes out, and we're expecting no change there. But the big one really is the Federal Reserve, who report tomorrow, and it will be Jay Powell, the chairman's penultimate meeting. So he's only got one more after this. And everyone's going to just be very focused into what they're saying about the oil price spike. Whether they say it's transitory. So if you hear them say transitory, that means they're going to look through it. So it shouldn't push any rate moves they had in mind, of course. But people watch that very carefully. And the other thing is that they're going to be watching for how people vote. If you remember the last time they voted, there was a sort of 10-2 vote in favour of keeping rates unchanged, 2 people asking for it to be cut. This time, a few people are suggesting it might be 9-3. And if it is, that means that even though the oil price has gone up, there may be a bit of a move towards sort of more dovish, which is in theory more likely to want to cut interest rates. And of course, we're going to have a new Fed chair at the end of May. And as we know, he's probably more dovish in favour of cutting rates. But those are things to watch out for later this week. The other big thing really was, and we touched on it about a month ago, the Bank of America, Merrill Lynch, had their fund managers survey out, the monthly one. And this time, last one, which was basically for February, they were what described as uber bullish. I think that was the concluding summary. This time, they're finally turning more bearish, funny enough. I think the main things to bring out, they're sort of seeing there's caution coming into their positioning because of Iran, obviously, which you would expect because that's real time, but also credit risk, which we've talked about a lot in the last few weeks and a couple of months. And they're less concerned about the AI bubble. So that was things that came out in particular. At the same time, they've also cut back on the rate cutting optimism that you had before. Everyone was looking for 2 to maybe 3 interest rate cuts before the Iran situation. You know, the important thing is that actually, if you look at the market, we are now down to only 1 interest rate cut being built into the US sort of bond market for the rest of this year. Like I say, if we get through, as we've talked before, if we get through the Middle East crisis fairly quickly, then that could easily increase again. They're only saying that there's only a 5% chance of a recession. So they're clearly not worried that even though the oil price has gone up, that's not going to affect the economy so badly that it causes a recession. That's really important for equity markets. It's one of the reasons that US equity markets have been able to sort of maintain outperformance relative to the rest of the world, but also at relatively high levels.
Are these the same people that predicted a 100% chance of a recession in 2022?
That's exactly the right people.
The same
That's
ones.
the same people. Yeah. That great track record.
They're economists.
There was something else that I noticed in the survey, which was that the cash had increased at the fastest rate that it's ever increased between surveys, going from record lows to now a more average level.
4%, yeah.
But, that's quite interesting. And what it does suggest, and remember we've talked about this over the last couple of weeks, is that people have been looking at where they've been overweight and they've been cutting those positions down and raising a bit of cash. So the market's much more defensively positioned, ready for the next excitement.
Mm-hmm.
Yeah. No, it's interesting. I mean, we've been talking about private markets the last week. I've been scanning the sort of airwaves to see if there is anything new this week. The only thing I really saw of any note was the Apollo chief executive, Apollo is a very big private equity and private credit company, basically was fighting back a little bit against the tide, saying that there is a correction going on. And if you remember our terminology, a correction is about 10% fall, not a wholesale crash. And remember, a crash is 20% plus. So a little bit of a fight back there. Otherwise, bond markets had a bit of a tough week, actually, because the oil price is up about 13% since we last talked to you. That's in sort of 4 or 5 days. And we'll go on to talk to the Middle East now.
Well, we do have a 35-page presentation from Roger on the Iran conflict, major reversal of market trends, major asset rotation. So we've certainly got plenty to talk about. CJ, Chairman, sir, would you like to go through the portfolio first, or shall we?
Well, I think we should just have a quick chat about the portfolio. Then we can start talking about the situation in the Gulf and see if anybody wants to now pretend that they're a mine-sweeping commander as they're going down the Straits of Hormuz, because every press report I read at the moment is full of people telling me exactly how many mines there are and how they're going to get rid of them all or not get rid of them all.
Well, Chris, it's a stockbroker's privilege to be an expert on any subject after about 10 minutes.
As we talked last week, in the Gulf War, it was all tank commanders, and now everyone's a little boat commander. But let's look at the portfolio. The portfolio, week on week, down 0.3. It's a shorter week. We have only had a couple of days, therefore. Now, we've got 3 bullish, positive contributors. VanEck, crypto and blockchain, up 3.5%.
Hey!
And I have to say, Ethereum and Bitcoin are still pushing up. We called that remarkably well, I have to say.
I'm surprised it's only up 3.5%, considering Bitcoin's broken out, really, hasn't it?
Ethereum and Ethereum was up 10% yesterday.
Yeah.
Remember, it's not just crypto; it's also the effect of the data centers and that sort of thing. So, I think it looks pretty damn good to me at the moment still. So I still like it. And if Bitcoin and Ethereum keep going, then that will clearly drive it better. On the bear side, BlackRock World Mining. I mean, that's a chunky 6% fall. So what's driven that?
Oh, I think it's, 2 things, actually. And I think it's entirely logical. On the one hand, what you've seen is this sort of huge rotation on anything that worked prior to the conflict is not working during the conflict, as partly what your portfolio represents. And that's kind of easily explains your crypto move, and that is all I know about crypto, just in case you have any other questions. So it's obviously reversed what was outperforming at the beginning of the year and in 2025. And it's perfectly logical that you would get this as well. And I think that's what's so fascinating about how the market's moved over the last couple of weeks, is that everything has been pretty logical. One of the reasons why mining is underperforming, because the oil price has gone up, interest rates are going up, it will slow growth, etc., etc. Slowing growth has a direct impact on all cyclicals, and I think you can see that very clearly in what's underperformed this week.
Very energy-intensive industry, isn't it? Mining,
and of course, if it does cause any sort of global slowdown, then mining obviously is right in the teeth of that. So I think what you're seeing there in the bears, 250 underperforming, Russell underperforming again, entirely consistent with a rising rate environment as a result of inflation and bond yields moving up. So I think the bears look entirely as you would expect. I think the S&P is interesting. I think you talked about positioning. I think there was clearly a lot of very underweight S&P positioning ahead, or US positioning ahead of this conflict. And so to an extent, those have been filled as it kind of reflects a more defensive world, perhaps. So, yeah, I think your portfolio really does reflect that, as you kindly pointed out in the front of the presentation, major asset rotation. And that's what we've seen. And the question for you chaps is whether that continues.
Well, we got a new host. Brilliant.
That is Rich. Cheerio, Richard. Still up 14.2%. So that's good. So the question there is really, is the rotation going to continue? And I suppose what we wanted to do today was to talk a little bit about the war and where we think things are, but then really look the other side of it. Mm-hmm. And say, well, when it settles down at some stage, talk about what the themes might be then. So why don't we just have a few minutes on where we are in the war itself? Let's not spend too long on it, because we've done quite a lot already, and as I said, we are not gunboat commanders. But does anybody want to start off and have and say what they want to say about where they think we are? I mean, I'm quite happy to start if you want me to, but it's up to you guys to go to. I'm always being told that I don't let other people get a word in edgeways. So maybe if they go first, then I'll follow up.
Shall we do a few headlines? So basically, Trump is basically saying our people are speaking to their people. That was only yesterday afternoon. And actually, markets recovered reasonably well and have having a reasonably good day today. So I hope that we are beginning to get to a point where maybe there's some negotiated settlement potentially there. But of course, the Iranians are sort of denying that wholeheartedly. One of the big things, oil production basically in some of the non-Saudi states in the Middle East are down about 50%, because that's one of the strategies of the Iranians is to take out some other oil facilities around the Gulf. So they've cut that back. And of course, even if they produce it, they can't get it out. So they're trying to reduce their production and hold back as long as they can. But then obviously the Americans decided to hit Karg Island, which is where 90% of all Iranian oil goes through and gets processed before it gets into tankers and goes off to the rest of the world, mainly to China. And so that was hit. And again, a new strategy by the Americans. One of the greatest comments, I think, was this week was Trump saying, I'm not sure if there's any mines in the Strait of Hormuz. But apparently, I'd heard the reports there were 12. And so who knows, but we know. But one of the interesting things is, yesterday, it was admitted that there are some boats actually going through now. So the Chinese, the Indian, the Pakistani shipping companies have been able to push sort of boats through. So clearly there aren't that many mines there. And if there are, they know where they are. So we should follow them, I think, if I was advising our shipping or any other shipping. So those are the sort of main things I think that came up. I think it's important to remember that, yes, the oil price is high, but back in between 2011 and 2014, if you remember, we had an average oil price for those 4 years of about $107 for those 4 years. And markets went up through the whole of that very consistently.
But we had 1.5% inflation, didn't we?
We did. We had zero interest rates. And I think bond yields were about 2%, 10-year bond yields were about 2%. But I nevertheless think it's quite instructive. We had a period where we had a high oil price, and yet equity markets did particularly well. So if you in 2011 we had the Arab Spring, so everyone was worried about geopolitics in the area, and the oil price spiked up to $111 and then sat around there. That was the average for the year, $111, and the S&P was actually up 2% on the year. I have to say, unfortunately, the FTSE was down nearly 6%, and Eurostoxx 50, which is the main European markets, were down 17. This is a similar pattern to what we see now, because obviously Europe is much more dependent on importing oil and gas, particularly in those days, from the region, and that hurt them considerably. But the next 2 years, the S&P went up 16% the next year, then 33% the year after that, and 14% the year after that. And the whole time, the oil price was over $100. Other markets didn't perform so well. So, when we come to maybe talk about the portfolio and positioning, I think we have to try and get to a view whether we think the oil price is going to stay higher for longer. But what I'm saying here is really that markets can weather it. They can weather and absorb those higher oil prices for a longer period than most people think.
This reminds me of the comment that somebody put on YouTube, and I promise this wasn't me, that Mark's continued bullishness is starting to sound naive. That was a lot of bullishness that I'm not sure can tie into oil price being over 100. If it's over 100, I don't think we're in a good place. If it's under 100 and under 90, I think then we start to see the bullishness.
Doesn't it really come back to the monetary policy response?
Absolutely.
Because Mark's point, I think, is that if interest rates are down at sweet FA, which is what they were for most of the period that he's talking about, the markets can cope with most things. So, and I've been listening to a couple of economists over the last few days, which is not something I regularly do, and I don't make a habit of it. But they were basically pointing out that, if the inflation is coming from the supply side, that's a different response if it's coming from the demand side. And this is a one-off effect from higher rates, and actually is the right response to tighten rates as all the markets are discounting, or will they look through it, central banks, and say this is going to actually be pretty deflationary, it's going to slow things down, we need to cut rates. That to me is going to be the key. How do people react? How do the central banks react to this shock? And that will define who's right and who's wrong in this decision.
Well, I think I agree with all of that. I think that there are 2 points I would make to that. Is one, if you look at most scenario analysis that's been published, the National Institute of Economic and Social Research had some interesting. If the oil price is above 100 for a year, then that does have an immediate, has an inflationary impact of about 0.7%. So, would comfortably take inflation back comfortably above where the Bank of England target would be. If the price is above 100 for 3 months, then the inflationary impact is pretty negligible in terms of the scheme of things. And that really is the Bank of England's, or any central bank's, dilemma. And I think the second point I'd make on that, I think you've mentioned the word transitory a couple of times. I think transitory is probably the dirty word in any central bank thinking at the moment. The word that has no name. I suspect any central banker who sits at the table of the MPC on Thursday and says, this is only going to be transitory, they will go, well, you said that in 2022, and it certainly wasn't transitory. So I think central banks, maybe the Fed, maybe be a bit more, because clearly they've got less energy dependency than us, but I suspect the UK will be very sensitive to anything transitory, especially as half of the Bank of England, half of the MPC are concerned about structural inflation anyway, and this is just going to add to those fears. So I think it does depend which central bank. I suspect the US will be more prepared to look through this. The ECB, as ever, will be somewhere in the middle.
And that's why you get those price performances that Mark was talking about. The US performs better because they'll tend to look through it. The Europe is worse because the ECB loves putting rates up if there's any threats. So, that's where I think we probably are. It's working out what their reaction is will dictate what our holdings and how our holdings are going to appear in a relative sense. Because that's what we're really talking about, that relative sense. My personal view is I don't think anybody's going to raise rates. I think it's complete rubbish.
Apart from the Australians.
I meant proper nations.
Apologies to
our Aussie friends. But, to me, Europe, I don't think will raise rates. And if they do raise rates, they'll be coming down very quickly afterwards. And so the market will look through that. The market will say, if they do something stupid, gosh, they're going to have to cut again, and the markets will look straight through that. So I'm personally more relaxed than they are in that sense. I think we come back to what we've said before. This is all about how long it takes. If this is over quickly, that's fine. If it's not over quickly, then we're going to have some of these other issues. But I wanted to talk about a little exercise I like to go through when I'm a little bit confused as to what's going on. And that is, I like to look at the charts because they don't lie and they have no inbuilt bias, unlike most of the people I will talk to on a regular occurrence. So, you look at a chart, there's a line across the piece of paper, and it's just describing the historic performance of an asset. Now, whisper it quietly, but our job is to get the market right and nothing else. Our job is not to call the economy. Our job is not to do anything else but then get the market right. I have met many people who can explain to me the economic fundamentals, doctors of this and whatever, who can tell me how that variable is going to interact with that variable, blah, 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 blah. And I've met many rich people. I have not met many rich people who've explained the economic fundamentals. And that is the key point here. Most of the people I know who've made a lot of money have done it through feeling the market, and looking at the charts is part of that. Where does the market want to go? A perfect example is, I'll say Spice or Rich. Why has the market done something? And they're all over it like a rash. They're looking at it 24 hours a day. They can tell me exactly why it's happened. Oh, it's because some boat went through the Straits of Hormuz or something happened with NVIDIA and whatever. And, they may well be right, but that's just their version of why it's moving. And in the world we live in 24-hour news, people have always got to have a reason for it. But there's not always a reason for it. Sometimes it's because the market wants to do what the market is doing.
More buyers than sellers.
More buyers than sellers. Anything like that is what it's all about. Now, I've made far more money in my life by feeling the market rather than knowing about economic fundamentals. So if we look at the price action, what's it telling us? I think if we look at it last week, the markets traded really well until the end of last week. And when they got really dumped, all the risk markets came off on Fridays into the close as, now I'm going to put this in inverted commas, well-informed investors sold ahead of the weekend announcements. And of course, we come in Saturday morning, Trump has hit Carg Island, and everyone says, oh, this is an escalation. IG, who make weekend markets, as Rich talked about the other day, the oil price they mark up 4%, 5%. Equity markets down 0.75%. Everybody spends the whole weekend going, oh my God, here we go again. It's exactly the same thing. We open on Monday morning, but everything rallies. So we had a great trade on Friday. Markets were artificially pushed down, in my view. On Monday, they go straight back up again. And when we came into this podcast today, all the markets were having a great day again. Now, what that tells me is that although there's loads of bad news around, oil's going to $200, inflation and interest rates are going up, everyone's an expert on the Gulf of Hormuz, which mine layer is going to do this and which submarine's going to do that. The markets are telling you they want to go up.
Yeah.
That's what they're telling you. And therefore, I think we saw the bearishness hit rock bottom on Monday the 9th when we have that flash move down. And now this is looking to me like a pretty positive market at the moment. Now, don't ask me why in fundamental terms. I don't know. The markets are telling you they want to go up. So the real question for us as a group is, should we be adding risk here? Markets are telling us they want to go up. Or do we have enough risk on board to say that if they do go up, we're going to do well anyway? But there is always that off chance that something happens that we're not expecting and that causes some dislocation. Mm-hmm. So I love the way they're trading. I'm very happy with the positions we've got. But what I want is some guidance from you guys as to whether we've got the appetite to actually increase our risk a bit more from where we are at the moment. And where we are at the moment is, remember, 67.5% equities, 12.5% commodities, with 20% in sort of cash and bonds. So it's sort of 80-20 split at the moment. What does everybody think about that? And I this is it's an unknown. We like the way the market is trading. Well, sorry, I love the way the market's trading. Yeah. But it's a question of, have we got enough risk given the unknowns that are out there?
Well, I might just go first on a general point then before you talk about your specific portfolio. But one of the slides that we lead with is, if you look at the last 6 major oil events going back to 1973, if you had bought within the crisis itself, you would have made money. The only time you would have lost money by buying during the crisis was if you'd bought during Yom Kippur just after Yom Kippur in 1973. So only on one occasion, on any of the oil events that we've seen over the last 50 years have you actually lost money by buying during the crisis? And I think that is the historical precedent that certainly we talk about. And of course, when we talk about Yom Kippur, I mean, let's just be absolutely clear what happened then without going into too much detail. But the oil price went from $3 to $12. That would be equivalent to the oil price today, going from what it was, $70 pre-crisis to $280, if I've got my, So we heard a awful lot of wailing and moaning when the oil price almost touched 120. You imagine it going to 280, and that was what they were dealing with in 73, and a whole load of other issues that we're not facing now. So, as I say, I think history would suggest that at some point during the crisis, or really at any point during this crisis, as long as you don't think it's Yom Kippur, which I clearly don't think it is, then it's a buying opportunity, an opportunity to add rather than to retreat.
I'll give you that tenner later, Roger.
Yeah. The question of when is very important, right? So the buy is usually, on average, the market bottoms 19 days into a war. We are not going to be on air for another 8 days, which means we wouldn't change our positions for 9 days. So I admit that I think within 9 days, the market will have bottomed and we could start to see a rally.
I was called naive on YouTube. That's fine.
Disgraceful.
Disgraceful. I'm happy to say that because I think maybe I should have made myself clearer. I think that you've got to differentiate between what might still be a bombing campaign, taking out extra targets in Iran, and the bombing campaign carrying on, compared to opening the Straits of Hormuz. And to me, that's why I'm so bullish, is because I think we're very close to that point. As I say, this week we've seen boats go through from countries that are not going to be part of Trump's coalition, but nevertheless, they're not going to mine the Straits of Hormuz badly because Trump's going to blow them out of the water anyway. And like I say, we just follow the Chinese or the Pakistani boats or wherever we go and follow them out. And we will get that Straits of Hormuz will become clearer. And therefore, I think that's when we start to buy. Now, then there becomes two decisions to me. Once you know it's open, do the things that have had the biggest hit, like Japan, like Europe, have the biggest bounces back, like the mid caps, like the mid caps in Russell or the mid 250 in the UK, because ordinarily, Europe's down 7-8%. So you would expect it to, if you say take away the threat of this high oil price for a prolonged period of time, you would expect them to bounce back. Or do you say, okay, the oil price might take a bit longer to come through, in which case it continues to hurt Europe at the margin, in which case we want to be in the US, which are basically energy sufficient. They've got the one big beautiful bills starting to pick up. We can see from some of the data coming through that the US economy is beginning to gather a bit of pace now. And we know that we're going to get a new Fed chair that is going to be more cautious. And the US are not going to put interest rates up, because, as we know, they have a dual mandate, which is different to the other central banks. They can look at growth, they can look at unemployment, and they can look at inflation. In the UK, we have to look at inflation first and foremost, and stability of financial markets. And we're seeing no dislocation or no problems in the financial markets. And in Europe, they only look at inflation, really. For me, the dilemma is, do you put some more money in the US just for sort of short term, and if this oil price stays higher for longer? Or do you go and buy the things that have been hit the hardest, like Japan, like Europe? I don't know. I throw it in there. I think for me, it's a 50-50 call. For choice, I'd probably buy America.
Oh, that's a surprise.
That wasn't 50-50.
All right, 70-30. Okay, you got me.
70-30, 90-10.
I think if I was buying in America, I'd probably buy NASDAQ, because I think that the bubble, as we've talked earlier on about the fund managers survey saying that people are not worried about the AI bubble anymore. I think that probably leads to, after a decent derating, these companies have fallen back a long way relative to other assets around the world. I think they can have a catch up. Or I like the mid-sized companies in the US, as you know. I really like the Russell 2000, and I think that a lower oil price or a control of that's peaking out of that oil price will help the smaller mid-cap companies pretty well as well, with an accelerating economy in the US.
Yeah, to get this into some sort of context, is that I think you do have to look at what was driving the performance that we saw pre the invasion. And then the question becomes whether you think that's going to continue or not. What was clearly driving the performance, really, we certainly trace it back to Liberation Day and the tariffs back in April. You could possibly even trace it back to Trump's inauguration. But what you clearly saw was a rise in policy risk, and people call it policy volatility in the US. And it's that rise in policy volatility, whatever your views are of Trump, he is a disruptor in terms of a president, and that's probably being euphemistic. And then the second leg of what caused the performance over the last year or so and the beginning of this year was obviously that AI risk that you're referring to. And so I think it's the two very much together cause this rotation out of US assets, well, specifically out of the S&P into anything but the S&P. And people talk about it as the anything but the US trade. Once this conflict ends, and we can have a debate on timing, I think the debate really comes down to, do you believe that the trends we saw pre-invasion will re-dominate markets? And I think the question then is the policy volatility coming out of the White House more or less than it was pre this conflict? And I don't think this is a particularly contentious statement to make, that the policy volatility of what we've seen over the last couple of weeks is almost certainly gone up. And so if you were concerned about investing in the US because of mercurial policy 3 weeks ago, in 3 weeks' time, you're definitely going to be concerned about it. And so you get that rotation out of the US, certainly out of the US large cap and mega cap, into anything else. And I just can't see why that trade doesn't reassert itself once this conflict passes.
But haven't we seen peak Trump disruption? Because he's thrown in the extra tariffs with his 122 rule or whatever it is, once the Supreme Court pulled it off, and he threw another 15% back at you. But more importantly, this event in the Middle East is probably a huge throw of dice. His aim from now on to get through to the midterms, he must get the cost of living down in the US. Otherwise, he'll get decimated.
I think that I think is a secondary discussion. And I think that lends itself to when this conflict will end. But let's just deal with that first point. If I had a penny for every time someone said that Trump was going to behave in a more normal fashion in the two terms, then, I wouldn't be getting up at 5 o'clock in the morning anymore. So I think that is, you were described as optimistic. I think that's quite an optimistic.
Naive, I think.
I'll take either. I don't mind.
I think that's quite an optimistic view that Trump is somehow, we have seen peak Trump. I find that difficult. And, you only have to listen to him yesterday in terms of he will not forget. I mean, what does that mean? That presumably means he's going to...
Well, it's when Mark said earlier, when he said their people are talking to our people, I thought he meant US people talking to the UK people, because we've all fallen out.
We're not talking to them.
By the back channels, Starmer and Trump is going on in the back channels.
Well, they must be talking to Iran, because didn't the foreign minister say that there's definitely no communication taking place, so we can assume. But they're talking to everyone at the moment, I think.
I've got a bit of comfort in that, some of this oil's flowing now, in that the Americans could stop the oil flowing straight away. They just put a missile through the side of one of these tankers, it wouldn't carry on then. They're not. They're letting it go. So obviously there is flow going on into India, Pakistan, China, whatever else, and Trump's quite happy with it. So there's obviously some chat going on. Isn't it amazing how this conversation's gone? So I just want to draw this together. Yeah, as I said, to look at the charts, look at what's trading. Now everyone's fundamentally telling me what I should be doing, and that's my point. My point is my chart. All my charts tell me that is that the Nasdaq looks really good. It's gone sideways for 5 months. Not gone through the barriers sideways. It's absolutely gone sideways, which is a continuation pattern. And we, remember, are absolute return investors. I don't care if Europe does 10% more than we do than us. If we do, as long as we do plus and it goes up, I don't really care too much. And so I am more in the case of buying some Nasdaq, because Nasdaq looks to me the safest equity to buy. It probably isn't the most sexy equity to buy, markets buy, if this is the turning point.
Is that not where money's hiding, though?
It could be, but that's what I'm saying. What I'm saying is, remember, I'm looking at the absolute return of it. So if it stays still over the next 3 months, I haven't lost any money holding it. I've missed an opportunity, but I haven't lost any money. I'm just trying to avoid losing money at the moment. So I feel it's safer to buy something where the chart pattern looks as if it's in a consolidation pattern, rather than something which has had a big fall and looks like it's stabilized, but could fall again. And so to me, if we're going to buy, I don't want to be the hero that says I'm going to buy some more Japan or some more this or some more that. I don't want to be heroic here. I've got 80% effectively in equities already. I don't need to be the hero. So it's something that's safe or safe-ish, or let's not bother. And I think, judging from all this, I think we're all agreeing that we're positive, but we're not really sure we should be going in at this particular moment because there's still too much to be, to go on. And we can always buy at a later date when we know things have sorted themselves out and get back with the trend again.
It's important to remember that it took, give or take, 8 years for the Americans to decide they wanted to go and buy something outside of America, right? Which is why the US equities became 70% of the global equity market. Now, that's come back a bit because of the performance of the last 12 months or so. Now, the question is, and we've talked about this in previous podcasts in the last few weeks, when we are having sat on investment committees of big American asset managers that Chris and I have, when they get bearish of the world or they get concerned, they bring money home, they put a bit of money in their own market, they put a bit of money in cash and put a bit of money in bonds. And then when they get more bullish, then they start to think about putting it elsewhere. The trouble is they have pulled money back now. I'm not sure how quickly they're going to return to putting that money back out to other parts of the world again quickly. And no matter what we think, they are the marginal buyers of every market out there. They will move it. If they start moving money back out, then yes, those markets will move. I say they should be theoretically a short-term catch-up bounce from some of the things that have been hardest hit by the oil price. If the oil price comes back down to $70 or whatever it might do, and it settles back down there. But I think if you're taking a safer route, then I think the US will retain this outperformance that we're seeing in the last 2 weeks. I mean, we're only 17 days into this conflict, but I think that in that 17 days, we've seen very clearly that those American markets have performed much better than other markets. And I think, personally, that will continue for a month or two yet, at least.
I think you've very elegantly described what's happened. And again, I think that US perspective you bring, I think is very valuable. I think that's exactly what's happened. It's retreated back to something they feel comfortable with. There are a lot of other reasons as well. All of a sudden, Mag 7, instead of becoming an AI risk, becomes hugely defensive, large cap safety. What trades one of bonds, as people used to describe it. I don't know whether they do anymore. But yeah, no, I think you very elegantly described what has happened over the last 2 weeks.
As always, investment managers are very good at explaining what has happened and very poor at thinking about what's going to happen next.
I was actually going to leave that up in the air, Chris.
Well, I don't leave anything up in the air.
But I think the question is what point causes those US fund managers, if PIMCO, if the CIO of one of the largest US asset managers in the world actually said at the start of Davos, 2 days before Trump came, which I thought he must be the bravest investment manager I've ever come across, because he actually said they were divesting away from the US because of this very reason I was talking about, because of the policy risk of owning US assets. And if he's going to do that 2 days before Trump comes and speaks in Davos, I'm not sure that he's going to think anything more than that policy risk has gone up as a result of this adventure in the Middle East.
Chris, I just want to introduce one thing. You touched on correlation last week.
Yes.
So there's another term that I would like to bring to our viewers and listeners, and that is dispersion. Now, dispersion is something to keep a real eye on because it's in these precise kind of markets when it rears its ugly head. So normally markets act in a tightly coordinated kind of way. They are consistent. The movements relative to each other are very consistent. And that's what you talked about last week with the correlation. So think of it like a shoal of fish that's all moving round, tightly coordinated, and they move in these wonderful patterns. Equities were going higher, bonds were softening, commodities were up and down depending on which one, but it's all very predictable and it's stable. Now, dispersion hit a high, the highest point it's been since 2022 on Friday. And that just worries me because when dispersion rises up to a level called 18 that it is at the moment, we only see that 2022, we saw it during COVID, and that means those correlations are broken down. The movements aren't stable, they're not predictable, and imagine that shoal of fish. A shark has just come and they've all just gone, boom, off in different directions. So it's really hard to choose which, asset class we'd invest in just now, it's hard to give any meaning to the relationship to charts, harder than it normally is because that dispersion is so high. So I would personally wait until it starts to come down beyond a reasonable point. Again, wait till volatility comes down and the correlations come back to add to anything. But I know you're going to go ahead and do it anyway.
No. Just to be honest, I was going to say. I mean, I'm quite keen on adding, but I think we need to be clear that I think if we were running our own portfolios at home, we would feel like we might be able to add something, but we've got more flexibility there. With the way we set ourselves up in this podcast to make sure that everybody can join in, we have to be clear that we deal on the day it comes out, and then we can't deal for another 7, 8, 9, 10 days, whatever it is, till the next podcast. And given where we are in terms of our overall risk levels already, and given that although I think we are optimistic, we've got an optimistic portfolio anyway, it probably is better to sit and wait and just wait for a bit more clarity to come through. Because whilst I'm happy that the chart looks really good, once again, I come back to what we were talking about. I can't work out what the fundamental is that's driving why it should look so good. It could be that tomorrow that Trump's going to say, I've won. I've got everything I wanted, as he will do. We know that he will do that. And suddenly market's up 3 or 4%. It could be that something else happens tomorrow, that NASDAQ stays in its range, but it doesn't do anything and everything else does badly. But NASDAQ is still staying nice and steady, which is what my charts are telling me. So I think at the moment, I would say I'm happy with the positions we've got and let's leave it until next time. I think we've had a very good debate about it, but I just don't think there's enough clarity. I'm persuaded that I think, there are good reasons to wait, that we're not quite sure whether which area of the market we should be buying. I'm very much with Roger here that when this is over, the same trends will reassert themselves, which were there before, about US underperforming and everywhere else doing well. But if we're still in this for another 3 weeks, it'll be do the opposite. So, at the end of the day, I think we'll just wait as we are and kick this subject into touch, because it does get remarkably boring when nothing really changes, especially when we have a guest of this skill and caliber who we can talk
wasn't
about.
able to make it this week. Yeah,
who we can ask about some of his thoughts and insights, given his background, on a more general basis. So what I would suggest we do is we park the portfolio now and ask some questions to Roger. Mark wants to get something in. The ball just wants to get, the naive bull wants to get something.
The naive bull, that's a great name for me now, I'm sure. All I'd say is for people at home who've run their portfolios. Now, some people may have panicked a bit when they've seen the headlines. First of all, that's a natural reaction. They decided they wanted to do something, want to put some money in cash or whatever. I think they have to sit there and ask themselves, what happens if you see certain headlines from here? And what happens if the war is over tomorrow or next week, or the Straits of Hormuz are open and the oil price is back at $70? Can your portfolio, if you've bought loads of defense stocks, loads of oil stocks, and you've sold all of your cyclical things like airlines, etc., and holiday companies, that could be completely reversed very quickly. So if you've taken positions in those, you have to ask yourself how your portfolio is going to perform should you see a headline like that, and then make your own decisions about whether that's, you're comfortable with that, or maybe you've made some good money on it, or maybe a profit's never a profit until it's in the bank. So, all I'm saying there is just think very carefully about what the next sort of headlines might be. My instinct is the headlines are getting better, not worse from this point.
Better for a
bull, like me, obviously.
And I would agree. I think all of us agree that chances are by the time we're here next, the market's 4% higher. We don't know which market, but oil's probably $75 and the market's higher. But it's just the patience that can pay off sometimes.
And we have said before, patience is one of the key skills of a successful fund manager. So we will sit on our hands for the moment.
Okay, quick question. Do you invest in your child's future? IG have just launched their new junior ISA account. And right now, if you open a new account, make your first investment of just £50 or more, IG will match it, dropping a £50 bonus straight into your child's junior ISA. Use the code JISAPodcast at sign up. That's JISAPODCAST and get the offer before it closes on the 5th of April. An easy way to start investing in your child's future. Give them a head start. Sign up today. Your Capital at Risk new customers only offer is valid to the 5th of April 2026 on JISA accounts. Terms and conditions apply.
Okay, so firstly, Roger, what I would like to ask is an easy one to start with. Why has the UK bond market done so badly in this crisis? Why have our yields gone up more than any other yields in the developed markets? What do you put it down to? Is it right? Is it wrong? What do you think?
I think it is a relatively easy question to answer on one level, and on another, it's actually quite a complex situation. But the easy answer is that our rate expectations, the market was expecting at least 2 rate cuts this year, possibly 3. That had the effect of pulling bond yields down across the curve, not just at the short end, but at longer end as well. And that was the real positive story behind gilts, I think, over the last couple of months.
So for everybody's benefit, really what you're saying is the market was discounting a lot of rate cuts. And we've talked before to everyone listening that the shorter maturities perform best in that environment. But the overall effect is to then bring all the bond yields down and make it go a bit lower.
Yeah, absolutely. I mean, that's exactly what happened. And there's a lot of debate about, well, you're the bond expert, but obviously there's clearly a lot of debate about what happens, across the curve when rates expectations fall. But what we have seen, or what we have observed, is that rates across the curve have come down. And that is the key point up until this crisis. And now what we've seen during the crisis is, because of this threat of inflation that we were talking about at some length earlier on, because of this threat of inflation, particularly for the UK, because we are seen as being a very oil-dependent country, question, given we have substantial reserves of our own, but that's a different subject and perhaps a different podcast.
Don't get me going.
The point is that we are energy dependent. We are dependent on imports. And then, as I think I mentioned earlier on, I mean, there is a reasonable likelihood that inflation would go up if this crisis persisted, and the oil price would go up. And that means that the market has now started to discount those rate cuts, has started to view those rate cuts as being improbable. And as a result, the market's now only expecting, well, it's not really expecting a rate cut at all.
I think it's expecting a small rate rise. It's price rate rises.
We did at one point during the crisis actually start to price in a rate rise, as you say. So that's really, in a simple terms, what happened. Rate expectations have gone up, and that has taken the curve with it. And that's why you've seen bond yields rise and bonds sell off, and the underperformance that you've seen.
So expectations were lots of rate cuts. Now we've had the news come out. Everyone's gone, oh no, rates might have to rise instead. And all we've seen is the pricing out by the market of those. And I think we mentioned last week that one of the big hedge funds, Caxton, was rumoured to have had a hugely overweight position in UK government bonds. And therefore they probably had to cut those positions out. And that's caused a bit of carnage within the gilt market.
I think one of the features of the UK market, or UK gilt market, was that we have rates at the moment, interest rates at the moment at 3.75%. We arguably have the biggest scope to cut rates in the whole of the developed world. So let's just think about that for 1 second. So we had rates at 3.75%, Eurozone rates at 2%. Now, our inflation was coming down. Our growth is somewhat challenging. And that could be an interesting why that is the case, but growth is certainly challenging in the UK. And if we look around the world, Eurozone rates at 2%, unlikely to cut further, maybe only 0.25%, 25 basis points perhaps. This is pre-crisis. Japan's raising rates, it's not cutting rates. And in the US, well, there's a huge debate in the US about how much rates can fall. Now, in the UK, on the other hand, pre-crisis, we were at 3.75%. There was plenty of people, ourselves included, who were expecting 3 rate cuts, rates below 3% prior to this crisis. The average differential between ECB rates and the UK rates, bearing in mind we are only 19 miles apart.
At our closest. The Straits of Dover rather than Straits of Hormuz.
I thought you were going to say
Lots of minesweepers there, I tell you guys.
I thought you were going
Let me talk to you about the mines that are in the... Oh no, can't do that, sorry.
Yeah, the ideological difference may be somewhat further, I think is what you were trying to say, Chris. We are only 90 miles apart. And so, the average differential between ECB rates and the Bank of England has been around 0.8%, 80 basis points, which would be entirely consistent with UK rates coming down to below three. And so we had the market with the most scope, I would argue, to cut rates in the G7. In the developed market world. And I think that is where the positioning was, that rate cuts come out of the market, bond yields go back up. Clearly, that is catching people on the wrong side of that trade. But what's more complex, if we want to discuss this, what is more complex of why is the UK so exposed to these sort of shocks? And that is a lot more difficult to answer, or easy to answer in one level, but a lot more complex. And that is because the fiscal position of the UK is more vulnerable to external shocks than many other countries. Now, that's not me saying that. That is the Office of Budget Responsibility saying that in one of their recent reports. So there's two elements to this. One is just simply rates have moved, rate expectations have moved. But the second element, it really is showing or shining a light on that vulnerability because of our fiscal position. And that is a political issue.
It's interesting. You say that there's more scope to cut rates in the UK out of the G7 than most other places. And the Bank of England have been cutting rates, even though they have a mandate to try and make inflation around 2%. We've got 3.4% now at the moment. And they've cut 5 or 6 times in the last few months with inflation much higher than this. So I don't think they can use that as an excuse because they've already been cutting when the inflation is way above target. To me, I think there's a much bigger question about credibility and the inconsistency. Because if they'd said, we are not cutting rates until that inflation gets down to a level that's much closer to 2%, then the bond markets would have performed better, I think. Instinctively, because they say you are serious about trying to get your inflation under control. And I think that they have basically shot themselves in the foot. And this is not the first cycle they've done that. And they're the ones who you keep using the word transient. If there's an increase in inflation, it's just transient. So we'll get through this and then we can, so we don't really need to worry about what's exactly happening now. And I think bond investors globally have taken the view, well, you're not really serious about your target. Therefore, why should we trust you? And therefore, you have to pay a higher risk premium to invest in the UK.
I don't disagree with that, really. But before the crisis, UK bonds were outperforming everything because everybody had that view. Everybody said it's a problem. And suddenly, people were starting to see the bull argument of 3 rate cuts or more even. And everybody had the different position, which is why it was performing so well. But we've walked then into a crisis where everyone was lined up on one side of the Titanic. And now they've gone on to the other side. And so it's, once again, we've talked about positioning is so very, very important. But talk to us about the fiscal positioning, because I think most people would listening to this would say, yeah, look, clearly we're borrowing a lot of money. When we talk about the fiscal position, remember, we're talking about the difference between the government's expenditure and the money they're getting in. And that gap is what has to be financed. Yet now, we've had 2 tax-raising budgets attempting to put us on a course to narrow these deficits and take away this problem. So what's gone wrong here? What is it? Is it people aren't really understanding what's going on in the background, or are they missing something?
Oh, well, the easy answer to that, again, there's an easy answer and there's a very complex answer.
Keep it easy for us. Keep it easy for us, please.
The easy answer is the government this is not a political point, this is a fact, that this government is the largest tax-rising government as a proportion of GDP since 1970. And we've only had 2 budgets. We haven't even gone through the full parliament. The government has raised 70 billion in tax. I mean, these numbers are huge in any sort of historical context. And quite frankly, what the government have done with that is they've spent it. They have basically raised tax in order to spend. And that then brings us on to just very quickly what this deficit is, because it's shrouded in mystery. People quote these numbers, 4%, 3% deficit. The OBR, this Office of Budget Responsibility, and the government say that this deficit is going to be coming down. So as you say, what actually is the deficit? Well, the deficit is the difference between two very large numbers, and that's why it's so difficult to forecast it, and that's why the Office of Budget Responsibility and economists find it so difficult to forecast. So the two large numbers, very broad terms, the UK spends about £1.4 trillion per annum. That's the current budgetary forecast, about 1.4 trillion. The government raises in tax revenue and other income around 1.3 trillion. And so the difference there that they have to go out to your former employers to borrow in the gilt market, in the government bond market, is circa 100 million. Now
billion.
that 100 billion, yes, I wish.
100 million. Easy.
100
Rich could
million.
pay himself.
We're a Gulf state. We're a petro economy if it's only 100 million. So you have this. So this gap, this deficit, which is effectively all we're talking about, is what we have to borrow each year of 100 billion. Now, we then measure that borrowing as a proportion of our GDP. So I'm going to give you another number now. So the size of the UK economy, GDP, is around 2.9 trillion. So you do the maths simply, 100 billion of borrowing over, well, let's between friends call it 3 trillion to keep the numbers simple. And you get a 3% deficit. Now, economists think that 3% deficit is sort of ideal. It shows the economy is using leverage, is funding itself, and that is a sort of target around a 3% deficit. The problem for the UK is we're not borrowing 100 billion. Last year, we borrowed 150, and this year we're forecast to borrow 140. So again, we'll do the maths again. 140 billion over 3 trillion, and you're getting a deficit of 4%. Now, that in itself is not a problem. 4% is probably okay for your former employees in the gilt market. The problem comes if that deficit starts to creep up to 5.5% or 6%. Now, these are the magic numbers that economists always talk about and the bond market gets very concerned about, because all of a sudden, 6% means that we now have a significant shortfall. And again, just doing the math, 6% of 3 trillion is about 180 billion pounds. So this is why it's so sensitive. So 100 billion is fine. 180 billion is problematic. Now, 80 billion is a very big number, but in the context of 1.4 trillion of expenditure, 1.4 trillion of income, that 80 billion can really be a rounding error. And that's where the problem comes, And again, I'll throw some numbers, very quick numbers at you. So the welfare bill at the last budget went up £10 billion. So a significant amount of money. The OBR talk about if GDP slows at all, that could cost us 11 billion. If tax revenues fall, that could be 20 billion. If these gilt yields, if they cost us more to refinance, every 1% these gilt yields go up costs us another 15 billion. So all of a sudden, you get a slowing economy, rising unemployment, higher gilt yields. So rising unemployment would imply less people in work, so less people paying tax. Rising unemployment, they would then be claiming benefit. So all of a sudden, we have less income, more expenditure. Gilt yields go up. That is straight more expenditure for the government. And this is why the OBR describes us as being in a very vulnerable position, because the sensitivity to these very large numbers, when we are faced with any sort of external shock that could result in a slowing economy, slowing revenue, or rising expenditure, can take us into that danger zone of 6%. Now, just to get that into context to conclude, France, which has had ongoing budgetary issues, they are running a budget deficit at the moment around 5.5%, and that is seen as problematic, though they fortunately have the ECB behind them. And this is what I think is what the gilt market gets concerned about, and why our gilt yields are a lot more vulnerable and therefore sell off more than the rest of the developed world.
And just before we came in, you showed me a great graph of gilt yields, the 5-year gilt yield to the FTSE 250. And the relationship between the two is astonishing.
Yes, well, I mean, that's a sort of secondary issue to this. And that, again, that's the interest rate expectations, why your 250 portfolio has underperformed, or why they've been particularly challenged over the last couple of weeks, is that there is a very close correlation between mid-cap UK stocks to interest rate expectations. And we'll just think about that for 1 second, because it actually is quite intuitive. UK small caps, far more domestically exposed than our mega caps, obviously. They're far more domestically exposed. They are far more exposed to UK PLC. Interest rates go up in the UK. We obviously have to spend more on our mortgages, et cetera, We have less money to spend in the economy, and therefore the market just effectively assumes that the UK is going to be a more difficult place to do business. Which companies are exposed to the UK small caps. So you get this very close correlation between interest rate expectations and small cap and mid cap UK equities.
I think a big element of the whole maths behind the OBR and the deficit is growth. We don't have growth. They're raising all this money, and yet they're not creating growth in the economy. Now, I have to say, the Americans are much better at doing that. If they raise money, they pump it back in the economy. The one big beautiful bill, which I know you're bored of me talking about, but it is stimulative. It is stimulative for the economy.
I still find it interesting.
I mean, we'll be lucky if we get. If we'll be lucky if we get 0.5% growth this year in the UK, and the US are going to do 3+.
So hold on.
So that's a big element. That's a big part.
So I'm going to go the other way. I'm going to give a little shout out to my socialist friends and think about the response to that. So the response to that is twofold. One, Japan doesn't have a problem and it borrows a lot more than we do. Number one.
So I don't mean to correct you on that. They borrow a lot more.
They
borrow a lot more in terms of their absolute level of debt. I mean, their debt level to GDP is over 200%. They actually run a budget surplus. The bond market is not there to fund their day-to-day expenditure.
But at some stage it was. At some stage it was over the past few years. Otherwise, it wouldn't have got to 200%.
And they had deflation.
And secondly, their bond ownership is a lot more domestically.
So we're playing into my argument. So if I was sitting here with my friend Zach Polensky, he would be saying, "Who cares? Why don't I just issue more and more bonds? And it's the magic money tree, and we don't worry about it." What's the problem with doing that? Because at the moment in the UK, we saw the Greens win that by-election. There's a load of people saying, why are we worrying about this stuff? Why don't we just borrow? Why don't we just print money, essentially? Respond.
Well,
please.
It's a very simple supply and demand dynamic. When the UK government or any government really issues more debt, the price has to respond to that increased supply, and therefore usually price goes down, i.e. gilt yields go up. So it is essentially a supply-demand dynamic from a very simplistic perspective. And we've had 4 occasions. This is why I find it such an interesting debate. We've had 4 occasions since this government came in when gilt yields have gone up 0.2%, 20 basis points, very, very quickly. Now, you've been in the government bond market for years. A 20 basis point move in minutes, certainly when Rachel Reeves had her difficult day and there were signs that she was going to be didn't have the Prime Minister's fulsome support. A 20 basis point move is pretty serious in the gilt market. So we've had 4 occasions of this now. So it's not just this week that the bond market is concerned about gilts. And funding and the deficit and this fiscal issues. The market's been concerned about it now for over a year. That's what puts us in this special place. Now, there is another reason why we have a particular problem, and that is that a lot of our debt is funded by overseas investors. We don't have a huge domestic owning gilt culture. So if we were having this conversation in Japan or we were having this conversation in Italy, by and around this table, most of us would have our assets in some sort of government bond. We tend to use cash deposits as our primary savings vehicle in the UK, is basically bank deposits, simplistically. And in other countries, they use the government debt market. Now, that means that there is a ready buyer out there We, on the other hand, have to fund ours on the international markets. We compete for capital against the rest of the world, which is partly why our gilt yield is quite closely correlated to US Treasuries, because we're basically competing against them for the buyer, or the marginal buyer. This isn't a new phenomena, clearly because the UK savings behaviour hasn't changed. If older listeners will remember, Dennis Healy back in 76 talking about the gnomes of Zurich. Now, that was his sort of rather pejorative way of describing the global investor that you were, Chris.
First time we called a gnome. That's certainly true. Or from Zurich.
So there are a number of factors of why we are exposed. Some have been historically there, structurally there for a long time, and others are very, very particular to the current government's choices over the last 15, 18 months.
So I think what you're saying is we are very vulnerable to the international buyer saying he doesn't like what we're doing, and therefore we need to impress them that we're doing a great job and we're keeping control of everything. So it would have, the tax rising part of what we've done in the last two budgets is probably good for them, but the spending bit isn't quite so good. Let me just move this on though for a sub. We bring it into the Gulf situation. We've got to get our spending up on the Ministry of Defence and buying more missiles or drones or minesweepers. Thank you very much. Well, how are we going to do it? You're Chancellor for the day. How do you move us to 4% in one fell swoop of spending?
One of the issues we have, which is why we're struggling to fund our defence bill, is we have no growth. But let's park that for a second and give you just some numbers for the viewers and listeners to think about. So, reason why raising money for defence, the numbers are huge. If we just went to 3%, that's 15 billion of increased spending per annum. I think
that's from 2.5, aren't we? So
2.5.
So 30 billion from each 1%.
Yeah.
So 45 to my target.
This is a huge number. 45 billion is a huge number. That immediately takes that deficit from 140 to 180, which is obviously what we just talked about being as the danger zone, if we can call it that. And essentially, defence spending is a government choice. Now, since the Cold War, defence spending as a proportion of GDP has come down in the UK, as it has in most of Europe, if not all, certainly except with the exception of Eastern Europe. As defence spending has come down, welfare spending has gone up. And we have chosen, and I'm not making a comment about whether this is the right choice or the wrong choice, but the government, successive governments have chosen to spend more on welfare than they have on defence. If the economy does not grow, and we are in, the pie doesn't change, then the government will have to choose where it funds defence from. Now, this is where you get the sort of the popular meme that was circulating around. I think I just said your welfare spending went up 10 billion in the last budget. Broadly speaking, a destroyer like HMS Dragon costs about $1 billion, $1.5 billion.
It doesn't cost that much, is it? Because
it's
in the dock most of the time.
Yeah, we can't afford the oil.
So we can't afford the oil. We don't have any crew to man it. But other than that, these are political choices. And so where do they fund it from? The simple answer is, I don't know. It was a question, would the bond market, I think, would the bond market agree to specifically fund issuance to rebuild our defences? I don't know. We've never done that before. We've done it in wartime. Would the bond market be happy with that? I don't know. If you read the Institute of Fiscal Studies response to the spring statement, they identified this as being one of the key risks to the UK fiscal position going forward, is how do you solve for this increased defence spending going forward. And I would also say that risk has increased because one of the responses I'm sure Trump is going to make is going to expect NATO to foot even more of a bill of their own defence going forward. So the simple answer is I don't know. It's about defence. It's about choices. The choices are, I could give you, if you cut, let's say, what we're trying to get to, 45
billion.
So let's say we want to get to 45 billion. Well, if you were Chancellor for a day, now it depends whether I'm going to get re-elected as a Chancellor, but if I was Chancellor for a day, the Policy Exchange, a very well-known think tank, have written about how you get savings out of the UK economy. Now, this is going to be desperately unpopular, but you freeze the state pension for 3 years. and then you increase it by CPI. That's 22.5 billion. That's half of what you require. Welfare. You have a 3-year freeze in welfare, and then you increase it by CPI. That's 30 billion. That's your defence budget.
There we
Done.
go.
So it's all doable. It's whether the political will is there to do it. And, we're talking earlier on, Jean-Claude Juncker, he's one of the few contributions I think he's made is this great line that politicians know what they need to do. They just don't know how to get re-elected once they've done it. And this has been the issue around controlling welfare spending in the UK over successive governments. They know they need to do something about it, but they just do not know how to get re-elected once they've done it.
Okay, so about to draw it to a close, but we always like to talk to our guests about the UK stock market and the fact that we have a whole host of people in this country holding a lot of cash. And we're trying with IG and with lots of other people out there to try to encourage people to take that step, move that cash into equities, look at the wonderful returns over the long term you get, and how much that could contribute to your financial journey in the future. So same question to you as we've asked other people. A, do you agree that it is good to get money into the UK equity market? And B, if you do, what would you do to try to encourage people to put more of their money into risk capital, into equities, and hopefully get them then on the same journey that our American colleagues have done by having so much in US equities and that being so helpful to their overall wealth?
One, I don't think it should be through coercion. I don't think that is the right approach. I don't agree that pension funds should be mandated into increasing their weighting in the UK. And that's obviously, as an equity market practitioner,
We would agree with that.
That is something that would be when I first started. And when we first started, the weighting to the UK was around 40%, and now it's 4%. But I wouldn't agree with coercion. I think the incentive has to be there for its own reasons. And the primary reason people will start to invest in the UK is when it starts to perform better. And that comes back to what we've been talking about in terms of this, diversification trade out of the US. It's when UK markets perform better, as they have done pre this crisis, as they did last year, the 4th best performing equity asset class last year, comfortably outperforming the S&P. And that will then lead people back to the UK. Performance leads to asset flows. And I'm afraid it's as simple as that, whether it's from an institutional perspective or whether it's from a retail perspective. It's performance.
So not trying to lead the witness, but I agree with you about mandating. We shouldn't mandate anybody, but what I would do is I would encourage them by giving tax efficiency for investing in the UK relative to investing elsewhere.
Well, if we're going
are we thinking like that?
Well,
or
if we're going into a
that?
specific proposal, and again, this might be quite controversial. I stress this is my own view. It is not our firm's view, but it is my own view. I actually feel philosophically that ISAs are a huge tax wrapping benefit. For 2 children, if you've got it, it's close to £60,000 a year of tax-free savings. That is a phenomenal number when you compare it to, even other economies, and certainly in other savings opportunities in the UK. 60,000 a year. Very, very few people save up to the 60,000 max. Where I struggle philosophically with that is a tax break that is given and funded and paid for by the general population, general taxation. General taxpayers, every single taxpayer in that country is offering and paying for that effective subsidy, tax subsidy to invest almost up to £60,000 a year. I find it inconsistent that money is then invested overseas or can be then invested overseas.
Totally agree with you. Completely with you. And I think that's something that we could really do something about, because as you say, if we change that in some way, we would see momentum come behind the UK equity market, which would drive it up, which would drive the relative performance, which would get people more involved, etc., etc. Now, Mark, my friend over there, would say, well, no, it's all about growth and earnings and all that sort of stuff, laying fundamentals in the way of a good chart. We talked about that earlier. But at the end of the day, you will need those fundamentals to come through. But the argument would be that if we get a better valued equity market, we start to have better funding within the equity market, there'd be more capital around to grow everything up. It would be right for me to say, given it's the 17th of March, I just want to mention, you've mentioned ISAs, I will mention ISAs. It is for all our listeners out there, now is the time, if you haven't done it already, to be doing your ISAs. IG have a wonderful offering within ISAs, and also you can do them for your children as well.
Well, that's it, because I assume the 60,000 you're talking about is 20,000 for each parent, and then junior ISAs 9,000 a year. So you get up to near 60,000.
It is a phenomenal
It's a great tax
savings
benefit.
vehicle. And, I've got 2 children, and, we've been lucky to be able to just do the ISAs a few years. And, you can get your university fees covered if you have the spare cash and invest it wisely.
All available at IG, as Chris says. Well, Roger, thank you very much for coming in. We've covered a lot. We've covered Iran, we've covered politics, we've covered the UK, and how much we encourage YouTube comments, especially if they're personal. But yeah, thank you very much for joining us, and we absolutely welcome you back at any stage.
Oh, thank you very much. It's been an absolute pleasure. Thank you.
Right, gents, where would people email if they wanted to email in any questions?
The art of investing at IG.com.
And it is the art of investing, because investing isn't just a science. In a world of algorithms and quantitative models, what would you say that art is in the investing world?
Well, I have to say, I did listen to a few of your podcasts, and anyone who wants to go back, and I think it was episode 19.
Was indeed.
I think was a phenomenal description of the art of investing and what traps to avoid and what opportunities to see. So I'm certainly not going to repeat that, though I think it is sort of required listening for any potential investor out there. And I wish I'd incorporated some of that into my own investing over the years, I have to say. I was going to leave you with perhaps a market saying that I've always enjoyed, and that is that companies rarely change, investors' perceptions do. And I think I would extend that into markets, indices, countries, that they rarely change, investors' perceptions do. And, we only have to look at how the perception of the US has changed over the last 12 months. The US hasn't changed. The growth is still the highest growth levels we've seen in the Western world, but the perception has changed. And I think you can take that from the US down to companies. We look at some of the quality growth companies that the market chased and believed in. They were seen as high intellectual property, high moats, high margin. In the last 3 months, they've been seen as an AI risk. They haven't changed. Investors' perceptions have. So I will leave your viewers with that thought, that it's not necessarily about charts. It's not necessarily about numbers and economists. It's about perceptions and how those perceptions change.
Wonderful. And that ties in well with us being very patient this week and our perception of risk and how to manage it. We'll see you next week in 9 days' time to find out if that's been the right decision. Thank you all.